Hey guys, thanks for joining me again. Today we're just going to do a quick overview of what we saw in 2023 and where that's put us for this first quarter in 2024, as well as how the rest of 2024 will likely play out. So let's jump in. Okay, so let's jump in with the values as a starting point. So year over year, we're up 11.1% on the median, and this is based on the Tampa Metro. But if you were to look across the board at the Tampa Bay market, you would see very similar trends. So we're up from 359,000 to 400,000 on the median, and that's a pretty substantial number given that we were anticipating somewhat of a lull this year in terms of value increases, just because we expected to see demand get sucked up in the market, which is what happened, but inventory kind of held us high, and we're going to go into that in a second. But if we look at year over the last 2 years, the average is actually up 30% and the median is up 17%. So we've seen a good run here, even though the last year and a half, 2 years has been fairly slow in terms of real estate transactions. And this is primarily due to inventory. So inventory, we are still down pretty significantly. We're down to 3.4. That's a 12% decrease year over year from 3.9. If you've listened to me before and, I've ever heard me go into any of the nitty gritty about absorption rates or supply, we really need this supply to get up into the 4, 5, even 6 range before we will see any kind of substantial change in terms of a seller's market to a buyer's market, or even just a neutral playing field, because sellers have really had the upper hand here for a while now. And given that we are at 3.4 right now, and we do not expect to see any significant, massive changes in inventory. Yes, there will be some inventory that comes on the market this spring, and as rates do subside, we do expect to see some sellers come onto the market, but there's not going to be a massive influx likely. And there's also not likely going to be a huge influx of inventory that comes from new builds or flippers or investors similar to what we do, because everyone's pulled back. Everything was expensive over the last 18 months in terms of not just the materials and the labor costs, but the cost to borrow money was significantly higher. And so it caused a lot of people to pull back. Year over year, we have seen the days on market really not change a whole lot. Again, a lot of that's due to inventory. So we were at 44 days last December. This December, we were at 48 days. Not a huge shift there, and we shouldn't expect to see a whole lot of changes there until we see rates start to come back down. So as we get into the conversation about rates, it appears that we peaked around October. On this chart, it shows 7.79. I saw people in the 8s around this time fairly regularly, and we've come down quite a bit since then, down to 6.6. And it's important to understand the differences in why we're seeing the rates start to trend down is not because the Fed's actually cut any other rates, because they are now talking like they're going to cut rates, but they haven't actually done it yet. But what's actually driving a lot of the decreases that we're seeing right now is the spread between the 10-year Treasury yield and the 30-year mortgage. And I'm not going to go into the details of these. I'm not even really qualified to go into the details of these. But what you need to understand is that there's generally an average spread of about 1.72, and that spread got way wider than it is typically. And the reason it did is because of volatility in the market. Anytime there's volatility or inflation, which we had both, then it's very likely that you're going to see that spread increase because people are going to hedge their bets. Now, with that being said, now that the Fed is stopped giving the rhetoric of we're going to continue to raise rates, they're starting to talk about we're going to actually, do some cuts this year. The sentiment in the market is starting to change because a lot of this is speculative. And as the volatility decreases, that spread will start to decrease. And so we're going to see rates continue to come down some, but they'll likely float close to where they are now until we actually see the Fed start to make some cuts. Now, again, I don't have a crystal ball. Most people are speculating that the rates are probably going to start to get cut. And this is, again, assuming that, all the inflation data and the employment data stays relatively the same and continues to trend the same. But assuming they do, probably around March, maybe a little after, is when we're going to start to see the first cuts. When we do, then the rates will start to come down. And it's really important to understand, what does that really mean for our current market, given prices are pretty much the same as where they were a year ago. In fact, they're a little bit higher. And to add to that, we have not a whole lot of inventory, which has been the case for, really the last 10 years, but it's gotten worse since COVID, is what does that really mean as these rates start to get down into the low sixes or low or even mid fives? And this is a chart that just basically shows what projected buyer demand will be out there. And this is based on some historical information, but it is not necessarily black and white. But it's very likely that all of the demand that's been sitting on the sideline will come back to the table once we start to see rates drop into the low sixes and mid fives. And when that happens, it's likely that we're going to see a wave come back. And if we do see that wave, it's likely that prices will go up because it's basic supply and demand economics at the end of the day. The other reason that this is very likely that you will see these buyers come back is because buyers have just been sitting out. Over the past 2 years, we are down roughly 40% in terms of the number of transactions that would normally occur. If we're looking at this chart, this is the Tampa metro area, so it is specific to our area. However, if you were to look at a national chart, it would be very similar to this. So in 2021, we're moving along at a good clip. All of a sudden, boom, the Fed decides that they're going to start raising rates because inflation is out of control. Buyers vacate the market, and all of a sudden, the number of transactions starts to go down. And so when you have a situation where you have had multiple years of people sitting out, and now you're seeing a return to more of a normalcy, we'll call it, and at the same time, we're in an election year, this is the perfect storm to see a lot of transactions potentially come back to the table. I keep seeing this reel that talks about that the people that buy at the beginning of this year are going to be like the people that bought at the beginning of COVID, when everyone was like, oh, the market's not very good, prices are too high, this bubble has to pop, and then boom, a year later, 2 years later, they're looking back going like, wow, I wish I hadn't set this one out because I left potentially hundreds of thousands of dollars sitting on the table over the years since COVID. And it very likely looks like we could be entering into one of those scenarios again. I don't have a crystal ball, but the things we do know is it's a presidential election cycle year. We have had 2 down years in terms of number of transactions, and the rates, while they aren't that great right now, the sentiment in the market is starting to return to more of a 6% rate isn't so bad anymore. And at the same time, it's likely we're going to see rates drop even below that into this year. And when they do, it's very likely that a lot of buyers will come back to the table. So, all these things combined, it's looking pretty likely like we're not only going to see a pretty fast-paced market this year, but we're also going to see values probably increase fairly significantly. Now, I'm not saying they're going to do the 20 or 30% year over year like we've seen in some of the other crazy years in the past 10 years, but it's very possible. And at the end of the day, I don't have a crystal ball, but all the metrics are pointing to we're going to have an up year this year in terms of values and number of transactions. So I'm hoping for a good year. I hope you're hoping for a good year, and I will look forward to seeing you guys on the next go around. If you have any questions, about this stuff or about, just buying or selling a house, please reach out. We'd love to help you out, and I'll look forward to catching you next time. Talk to you soon.